Good morning. How's everyone doing this morning? So I also wanted to reiterate, we are so grateful to have you all here, and I'm very excited to be in this room with some great thought leaders, both in Philadelphia and nationally, who are doing this work. So for those of you who don't know me, by means of introduction, my name is Ashley Putnam, and I have the privilege of directing the Economic Growth and Mobility Project here at the Federal Reserve Bank of Philadelphia. And as always, when we speak at the Federal Reserve, I get to give the standard Fed disclaimer. The views I express today are mine alone and do not represent the Federal Reserve System or the Federal Reserve Bank of Philadelphia. Hope you don't hear that too many times today. So I'm excited to talk to you a little bit about what we mean by investing in economic mobility and some work we've been looking at here at the Philadelphia Fed. But first, before I start, I want to explain a bit about why economic mobility. Why is this an important thing that we address? Why is the Federal Reserve looking at this? And what is the point of this Economic Growth and Mobility Project? So this is a relatively new strategic initiative that the Federal Reserve Bank of Philadelphia launched just about 2 years ago. And one of the reasons we really dug into this is because we, looking at data, realized that economic mobility is actually very important to economic growth. And so one of the things we reference here is a study that's done by the International Monetary Fund. If you can see in my little graphic, one of the things that we found really compelling from this data was that when looking across a variety of countries, they were looking at a variety of developing countries and developed countries, increases in income to the top 20% actually had a small negative effect on GDP. But really important here is that that increase in income to the bottom 20% had a net positive effect on GDP. So what does that mean for us when we think about economic mobility? It means it isn't just important for those people in that bottom 20%. It's important for every single one of us. To create sustainable, healthy economies, we need to be investing in the mobility of the people in that bottom 20%. So that is why we are here, and that is why we address this work. To tell you a little bit more about what do we mean by economic growth and economic mobility, here at the Philadelphia Fed, we really explore this in three key pillars. The first of which is infrastructure. So we care about things like housing, you're going to hear about a lot today, but also transportation, broadband access, the things that people need to physically access opportunity. We also care a lot about workforce development, and I'm going to talk a little bit about some things we've been exploring in that bucket, and job creation. And I think very specifically, the kinds of jobs that are created that provide those pathways so that people who are in that bottom 20% are able to earn more income. So I really we sum this up in terms of how we frame inclusive economic growth. This is a conversation we're hearing a lot these days. What does it mean to grow in a way that's inclusive? And for us, this is really about thinking on our local resources, our local talents, and our local businesses to create a virtuous cycle for regional economies. So how do we do this work? How does the Federal Reserve Bank think about economic mobility and bring people together around this topic? So as you know, and as you will hear today, we have some great strengths at the Federal Reserve Bank in terms of our research. But we also have a strength in our ability to bring people together around this work. This convening is just one example of that. So we have really launched something innovative here at the Federal Reserve Bank of Philadelphia that we call our Research in Action Labs. And that is us bringing research we are conducting, data that we're pulling into the field and thinking locally about community-driven solutions. So how do we work with our stakeholders, like many of you here in Philadelphia, to think about ways you can support economic mobility in your community? So we call these labs because they are a process, right? They're not a product, they're not a single report, they're not a book, they're not one event. They are a series of events held over a period of time, and for us, really a deep dive with a community to address some of these issues. We spent the last couple years in Northeast Pennsylvania looking at access to jobs and transportation, and we've been really excited to be exploring some innovative work in Philadelphia around workforce development. And so I'd like to dig in just a tiny bit today into something we've been learning in that conversation on workforce development. So this is a great build after talking about outcomes. But very quickly, why we do this work. One of the first things we have learned about what it takes for local communities to be innovative and lead solutions is that they require new kinds of partnerships, breaking down those silos, working across different sectors in ways that maybe haven't happened previously. So we really have a goal of institutionalizing partnerships. The second is to pilot and innovate, to try something different. There is a lot of risk that comes into thinking differently about how we invest in economic mobility. And so that requires maybe trying something new, a new financial model, something that might help us really lead that work into a new space. And the final thing we're aiming for is systems change. And I think we're going to talk about that a lot today. But I'll go back towards the end of this about what that means for us. So workforce development, one of my very favorite topics, and is also my background professionally before I came here to the Federal Reserve Bank. For many of you who are in the room, you might be familiar with a book that came out of the Federal Reserve System called Investing in America's Workforce. Has anyone here read that or heard about it? Great. Okay. Fed colleagues, of course. So one of the things we found in this really great volume in looking at this very important topic in our labor market was that there are some concerns about how we finance and fund workforce development. If you look at my little bubbles up here, you can imagine that each one of these bubbles is a different funding stream. We have WIOA funding and TANF funding. We have programs that support youth and programs that support reentry and programs that support people in public housing. But oftentimes these funding streams are very siloed and they're very transactional, meaning that people are funded, for example, for putting someone in a classroom, not necessarily for getting them through the training or getting them credentialed or even getting them into the job, not to mention staying on the job. Right? So this concern is also that oftentimes these are uncoordinated funding streams, right? You have the TANF funding says we need this outcome, and the WIOA funding says we need that outcome, and it's really hard to bring these things together. Again, just like we've been hearing, they pay for services delivered, not necessarily outcomes achieved. And there's often a low return on investment to the employers, who are really the people who are on the other side. We're hoping to get the candidates into employment. So we've been really thinking about how do we move towards that future state, right? I think it's something we all agree that we want and we all know is really complicated to get towards. How do we make sure that we're really aligning with what the industry needs, that we're building better feedback loops into the system, that the funding is coordinated, and that we're really thinking about investing in outcomes? So to understand this a little bit better, we really kind of took into account what are the things we know that are happening that we hear about in the workforce world. So I often say when we talk about workforce development, the majority of the conversation is focused on the supply side of the equation. We talk about skills, we talk about education levels, we talk about what people need on the supply side. But there is a lot more emphasis these days on thinking about the demand side. What are employers doing? How are they investing in the system? How are they engaged in ways that are different than how they have been traditionally engaged? And I think for us, one of the things we also realized is between the supply and demand, there's also a really important conversation on economic mobility about advancement, right? It's not just about connecting people to work, but giving people opportunities that give them that ability to move up. And so we really need to have a much bigger conversation. So we really came around this question saying, well, what do we do to get this side a little bit more engaged, particularly when we think about the financing piece, right? Who is paying for it is often not the employer. Or maybe they're paying for the top tier talent, but they're not paying for that middle skill talent. So how do we get employers engaged, but also get that feedback loop into the public sector? So to understand this, we really wanted to understand what's the return on investment case? What's the reason an employer should be engaged, right? If we're going to actually ask you, please come and be engaged and help finance some of these workforce activities, what are they getting out of this? So we actually sat down with, we had a couple different listening sessions to understand what that risk was like from employers, and finally brought on an expert in the field who does great work on this, social finance. And they came and really helped us do some research about what would it take for employers to see investments in workforce as a return. So just a very quick overview of what we learned from that research and that study. One thing we learned is what drives employer value. A couple different things up here. One was a growth hiring event, so recruiting, onboarding, productivity, but also turnover events were very big. So separations, decreased productivity, overtime, the revenue opportunity cost. Essentially, by losing an employee, employers are actually losing money on the backside. And so they're really concerned about the workforce development question in terms of job retention. So for us to understand that outcome, we had to do this research to say, what should the workforce development system be moving towards? And how do we get employers to invest in these outcomes? Eventually, we are able to bring together some very innovative and exciting partners to look at a pilot around this topic. And essentially what they have modeled out here with the help of social finance is a unique outcomes-based financial pilot where the employer is actually the back-end payer. So you'll hear a little bit throughout the day about outcomes-based finance. I think it's something we're all very excited about. We typically think about, say, social impact bonds, right? And in those instances, usually government is the back-end payer when the outcome is achieved. And our question really here was, what do we need to do to make the case for an employer to be the back-end payer? So this was a model that social finance suggested to us would be really functional in Philadelphia. We were able to bring together some exciting partners. And most importantly here, the workforce funder is actually not a foundation or a philanthropy. It is our public workforce board. And so the workforce board in Philadelphia said, we are willing to take that initial risk to create a customized training program if we believe we could get funding on the backside from an employer. So it really is a unique type of public-private partnership where there's an opportunity for innovation. We're going to learn a lot through this process. We're already learning a lot about communication between the public sector and the private sector. And I think we're really interested in that systems change piece. And that's kind of what I wanted to end on today. If you have more questions about it, please come up and talk to me at lunch or in the interim. But again, going back to why we think about these labs, why is innovation interesting and important to us at the Federal Reserve, and how does this move the needle in economic mobility? So for us, this lab has really been about thinking about stronger partnerships between businesses and workforce providers. We are very excited about this pilot, but the pilot is just one small piece of this lab, where we're really thinking about large-scale systems change in how employers are investing in workforce development. Again, the pilot is obviously one piece of how we're thinking about innovation, but we know there are lots of other ways that employers and the public sector can be coming together to work to address these systemic problems with preparing job seekers. And we're really going towards that long-term systems goal, right? That workforce development wouldn't be seen as something that is a social service or a charity or a nice thing to do, but really seen as a return on investment for employers, that they are involved in this not from their foundation arm, but actually from their human resources side, thinking about the cost savings to them in this investment. So this has been really exciting work that we have gotten to explore here in Philadelphia. It is, again, something we are still working on, and we invite you to continue having this conversation with us. And we look forward to hearing from you all about what you are doing in terms of innovation in your respective roles. So, thank you.